Well, thank you so much for sitting down with me. I really appreciate this.
Yeah, thank you, Danny. It's great to be here.
So you've already sold about $13 billion worth of property this year, and it comes after an anemic period for the industry, let's say, probably for the past 3 years. Is this the dam finally breaking?
Look, I think it's really good news. It talks about the trend of capital returning into real estate, and we're seeing it. So like you said, we've sold about $13 billion of real estate just year to date, which is fantastic. If I were to compare that to where we were last year at this time, it would have been about $3 billion. So you can see that really that ability to exit is expanding. But I'd say even more than that, it's still a very discerning market. So it depends on what it is that you are selling. So where we're seeing real success is selling really best-in-class real estate operating companies, businesses, or real estate assets. It has to be really pristine, cash-flowing, well-performing assets. And if you can have that, there's a lot of institutional capital that's looking to buy those kinds of assets.
I was going to say, how much of this is about Brookfield versus the industry as a whole for real estate, some of that gumming up starting to come loose?
Yeah, look, I think it definitely has a read through to the rest of the industry, but I think we're probably at the early stages of it, and it really comes down to what's your business model. And so for us, this is perfect for our business model because what we're buying generally are assets that need our operating capabilities, our platforms, our people, our resources and capital to invest in them. But our finished product, when we're done with it, is always these pristine cash flowing assets or businesses, and that's really what's perfect for the market today.
I say another thing that Brookfield often does is maybe contrarian's not the right word, but at least looking at things that have value to them, that look like they might grow in the future. And during the pandemic, office real estate was really an example of this. You leaned in a big way. Are you still leaning into office, or have you backed off in favor of other segments?
Look, office has been probably the most interesting sector in terms of just the amount of time that people have spent talking about it and the impact from COVID. I think what we said from the beginning, we're really seeing it play out, which is it's very much a bifurcated story. Office as a sector in the US, I would describe as being under-demolished, meaning there's a lot of lower quality assets that really don't have a reason to exist, and that's been really the issue. But for the Class A, high quality, best assets, which are the ones that we invest in, there's not enough of them. And we're seeing that demand continues to grow. People keep coming back to the office. And what companies find out is they don't have enough space for all those people. So we're seeing, I'll just give you one anecdote, which I think is interesting. In our own office space, we're downtown at Brookfield Place. One of our tenants just has seen exactly that. They need a lot more space than they realized. And we're being kicked out of our own space. And as we look around to figure out where to move ourselves to, it actually wasn't that easy to find the space for ourselves.
Does that mean if you want to lean into high quality office, there's just not enough there, that you can't continue to build up that portfolio because of the lack of supply?
Yeah, I think it's exactly that. You're going to see continued space crunch for the best office buildings, and nobody's building. The supply pipeline has obviously completely shut off over the last 5 years. Maybe that will start to turn back on, but it'll take a long time until that space is actually available. So we're going to see for a number of years now. I think occupancy is very high for the Class A plus, AA plus assets, and rents continuing to grow.
Well, for some of the more distressed type properties, I know you've had a little bit there in terms of handing back the keys in some LA properties. There's restructuring on a London skyscraper. Do you think the worst is over for those lower quality assets?
Yeah, look, I think so. I think it's, look, for us, we are nearly $300 billion of real estate assets. You're never going to bet 1,000, so we had a couple of incidents like that. But the reality is it's about the specific places and markets that have not recovered. I think most of that story has been told. Certainly for us, it feels that way. I would expect there will be, as debt maturities happen for others, or as leases roll that haven't rolled since COVID, there could be a follow-on of that for some people, but I think the main story is already over.
So in this idea of taking this classic Brookfield bet, finding something that's undervalued, where do you see that opportunity right now?
Look, I think it's actually still, our highest conviction is still in rental housing, and it's been for a while. And while that may not be completely contrarian, there's a chronic undersupply of housing across the world. Home ownership, as you know, in the US is really out of reach for most people. So people will continue to be renters for longer, and that means apartments, single-family rental, student housing, all the forms of rental housing are really interesting. But what we have seen in that sector is a real repricing that happened as interest rates moved up. We saw a real repricing of those assets. So today there's an ability to buy them from sellers that have to get liquidity, that can't handle their debt maturities. Values have come down. And so we can buy at attractive values and lean into what we think is really good fundamentals.
This industry is also grappling with another force coming in, and that's the likely allowance of private capital assets into 401ks, into retirement funds. Opinions vary here, but does real estate, a less liquid asset class, may be more risky for a more retail type investor? Does it have a place in retirement funds?
Look, in my opinion would be absolutely yes. I think what we've seen, most of our investors are institutional investors, but when you just look beneath the surface of that, who are those investors? They're the pensions, the biggest pensions around the US as an example, but who are they investing on behalf of? It's the firefighters and the teachers and the policemen and the government workers. They're getting great access to lower risk, higher returning private real estate assets, but why shouldn't everyone get access to that in their retirement accounts? It really doesn't, the way it sits today doesn't necessarily make a lot of sense. I think where we're heading to is a lot more logical, and there's a place in everyone's sort of allocation of their retirement portfolio for private real estate.
Well, you know, I'm sure you've heard this argument before, because the critics love to say, oh, everyone's just going to use this as a way to dump all their bad assets into retail. What do you say to those arguments to assuage any concerns that is ultimately what ends up happening?
Like I hear that argument. I feel like as a responsible owner of real estate who's investing on behalf of those same kinds of people just through their pensions, it's no different. We're going to invest that capital into the same private real estate assets, the same strategies, and really we don't view it as any different. It's just a similar but varied source of capital.
Just before we let you go, it's been this environment where Brookfield, as a global behemoth, you've seen globally appetite really ebb and flow for American assets just because of the political volatility. Where do we stand now? Are we in a place where some of that volatility has ebbed? Is there still from international investors a desire for American assets, or is political instability still upheaving some of that?
I think the main force would be that international capital believes it needs to be invested in the U.S., that the U.S. has the deepest, most liquid capital markets, and they need access to that, and it's an economy that continues to grow. On the margin, we are seeing a little bit of that noise. I'd say some of our international investors who are asking the question or considering whether they back out a little bit. I think we may see a little bit. It'll come to the benefit of investments across Europe and Asia. So obviously, as a global investor, we get the benefit of moving our capital around the world. But on the whole, I would say I don't think it's going to have any major impact.
Well, we're going to have to leave it there. Thank you so much. Really appreciate your time today.